Recording in progress.
All right, thanks. Good morning, everyone. So we'll be starting the session shortly. My name is Pan Zhi. I'll be the host for today's session. All right, so today we do have the strategy and stock pick for Singapore market. All right, so the slides will be showing on some of the ongoing promotions as well as for the agenda that we will have later. Okay, so we have some time before the event starts at around 10 a.m. Right, so one thing to note is that we do have an Q&A box that we have for the online participants to key in your Q&A questions. For those on a physical session, we can raise your hand during the Q&A sessions. We'll also be taking some questions from the floor as well. All right. So also for the online session, the Q&A will be chosen from the most upvoted questions priority also. Okay. So while we are flashing the promotions, if you find anything that's interesting to you, right, you can actually take a photo or scan the QR code. If you do need any assistance, look for our staff at the back. When you register, the same staff will do. All right. So I think some of you that came earlier, right, the booth are already at the back. So you should have received the card with 2 different stamps for the session, right? So you can get the 2 stamps from there and can redeem for the food voucher later. All right. right. Thanks everyone for coming down this Saturday morning. All right, my name is Pan Zi again. I'm the host for today's session for the Strategy and Stock Pick. So before I pass the time to Paul and his team to share more on the Singapore strategy outlook, all right, so we're going to share some of the ongoing promotions that we do have. All right, so in case you're not aware, so at least you're now able to see if these promotions are applicable for you as well. So the first one is, if you're not aware, right, if you refer your friends or family members that are not yet Williams account holder, you can actually get $68 per account that you refer that's new to Philip. So it's very simple, just get a referral link. If you're not sure, you get from our colleague. All right, the link for referral link, and then you key in your account number to generate your own unique link. And then you can thereafter share with your friends or family member to then open the new account. And after they do the funding of a certain criteria, you will then get the $68. Okay? Okay, second, we do have the ongoing margin financing promotion. So I think currently the rate is at 4.8%, which is slightly on the higher side of the high interest rate environment. But I think most of you all as an investor, you're also aware of the news ongoing right now that the US Fed is likely to reduce interest rates. So actually right now is good time to consider, to look at what is the options that you have to actually tap on to generate more returns for you through margin financing. You can consider for both Sing dollar and US dollar or even Hong Kong dollar. So even at 4.8%, I think you are aware that now a lot of REITs are actually performing higher dividend yield than this. Of course, the risk capital price movement might not be the best as of right now, but you can listen to our risk outlook later to find out whether it's actually an opportunity for you as well. Okay, so until the end of this month, 30th of April, which is actually ending soon, if you actually do any 3 buy trades for DLC, you are actually eligible for $88 cash credit directly from SocGen. But you must buy the SocGen listed DLC, right? Because there's 2 different issuers right now. So if you buy the SocGen listed DLCs, right, you can actually get $88 cash credit if you have 3 buy trades within this month, by end of this month. All right. Okay, as well as we do have currently right now this SDR, the Singapore Depository Receipts. Right now we have 8 different Thai stocks, the NVDRs, which are listed. So it's a Singapore listed entity. Well, Singapore listed listing for you to trade on for the SDR. Right. So right now it's at 0 brokerage. So if you want to try out diversification to the Thailand market, right, to diversify your exposure for the different sectors. Right, there's telecom, there's bank, there's the oil rig itself, and then there's even the 7-Eleven stores for the Thailand market, which is CPO. If you're actually interested in trading on any of them, right now it's at 0 brokerage itself, trading through the Singapore listing. All right, so you can find out more from this. All right, last one is we do have a Telegram also. If you want to have a market updates or receive some news, you can also scan the QR code to join the Telegram group. Then you can find out more. If you're not able to scan the QR code for now yet, you can also look for our staff at the back to find the QR code to scan to join the Telegram group. Right? Okay, so now I'll pass time to Paul and his team. Right? So Paul is the head of the research team for Phillip Securities, and then they do have a team that will encompass a large range of stocks that they cover. So without further ado, let me pass time to Paul.
Thanks, Hunter. Thanks everyone for coming and braving the rain. Actually, a hot day usually got more people because free aircon, but today maybe different. Okay, so thanks. So today we'll just share our usual quarterly strategy on Singapore. So most of our Singapore analysts are here. Everyone will take turn to speak on their respective sectors and stocks. So as the picture suggests, what we're just basically trying to say is that we think global economies is just going to be drifting sideways. The downside is protected. Any downside to global, so any recession is going to be out of the way because any downside is going to be supported by the Federal Reserve, you can see from the picture, or even by the government, the huge spending by the government that's going to be underway. The only problem is the thing they're all slick. So they might slip because of what's going on. I know everyone's asking about the conflict later, to have one slide on it just to address it. Okay, so nobody heard me, so never mind. Okay, I'm not going to repeat. Okay. Okay, next slide. Okay, let me go to the usual disclaimer. Everyone has to bear this. Spoken about this for a few hundred times, but again, educational purpose. We take public sources for info. I'm trying to summarize for you. This is for general circulation. Do look for seek advice from your financial advisors, which Phillip Capital has a number of them. For your own specific investment objectives and needs. Okay, just for the content, we have a lot of slides, but we're just going to cover the usual review very quickly, some of the macro backdrops or themes that we see in the market right now, technical sector, but the difference now is that we're going to add a lot more stock commentary on the sector because we got lots of questions about the stock, so I must just address them right now, stock picks and recent initiation. Okay, so quickly do this by 3 minutes so that we have more time for others. Again, we are forecast past, so no value add, but just to give you a flavor of what did well in the first quarter. So first quarter for the banks, the banks is 40% of the index. So the banks did well because of DBS. So DBS raised their 2024, you can ask Glenn later, raised their 2024 dividends by I think 20+%, and they committed to it. And the dividend yield at that time that drove the share price was about 7%. So basically, kill all the REITs. I mean, why buy a REIT when you have a bank paying you 7% in domestic bank, right? Then the other one that did well was Jiangsu because of the Red Sea conflict, it's actually doubled year on year. So of course, they rely on containers, so that kind of boosted the share price. And also the strong US dollar, because most of their costs is RMB, workers and so forth. The one that took a drag was Seatrium. Seatrium came out with their target, not a very spectacular target. I mean, they're looking at maybe 8% growth and they're going to triple the debt. So the target is to triple the debt. So investors are not happy when your target is to triple your debt to almost 2 billion. The problem with Seatrium is also because they are going to have a lot of costs, almost 800 million operational costs. What we expect to grow, that's fine, but you're spending money to pay for car wash here, car wash there, legal expenses, and also to pay for restoration, because once you merge, you have to restore the previous yard to a pristine, I'm just kidding, to the original condition. Then the REITs also took a hit, namely because of high interest rates. So most of the REITs still cannot outrun high interest rates. So although operationally they may be strong, NPI, that means the rent they collected after expenses might grow in teens or even high single digits, but the interest could just jump 2%. So whatever rent they collected have to pay interest. So that's why their DPUs cannot grow. So that's the drag. Next slide. Okay, again, nobody heard me, so okay, this is my last step to review. We usually just have a look at specific stocks. Then this chart is just show the respective asset class, just to give you a sense. So Singapore is US dollar, excluding this includes purely on the index itself. We did the ETF. So on the far left, Singapore virtually did nothing. I mean, it just went sideways. The one that you can see is the REIT sector, the one that was down 10%. So for the first quarter up to March, the big performance was of course the US. The US stocks again, they were up 10 and of course gold. So if you look at gold, actually the last 3 months actually up 20%. It's pretty amazing. If you guys questions, you can address that later. And I'll move on to the next slide. Next. Okay, we'll just run through the usual. Still muted. We'll just run through the usual macro themes. Let's give you the backdrop. Okay, so the first thing we want to for everyone to understand is that what we mean we're seeing now is unrestrained growth in the US. So basically, that's starting to stop them from growing. Why we say that is that if you look at the next slide, if you look at the GDP, if you look at the fiscal deficit, so for those who may not know, fiscal deficit means how much the government spends in the economy compared to what they collect. So how much tax they collect versus how much they spend in the economy. So as you can see, 2024, they're going to push the economy up almost at least 5 percentage points, which is a lot. That means if everything stabilizes, the government alone is going to push the economy 5. So this is going to keep the growth there sustainable. Not compared to Singapore, the government doesn't inject anything. So you're on your own. I'm just kidding, because they actually do inject, because some of it is actually investment returns. But we actually were worried that there's a bit of growth drag, because if you look at the arrow there, the sharp jump, this was 2023. So we were worried that by 2024, there'll be a bit of drag, because the government is not injecting, the US government is not injecting a lot of deficit in the economy. But even then, for up to the next 10 years, they're going to continue to inject. That's a lot, 5 percentage points. So imagine an economy as huge as the US going to grow 5% just by the government alone. One of the reasons is that on the chart here, you see is the amount of revenue they collect as the GDP. So basically, they don't raise taxes. So they're just going to revenue for the US is going to be, government's going to be flat. But what is autopilot? So what is the government spending on medical bills, give money to retirees, and also pay a lot of interest, almost $1 trillion. So that's why this deficit is going to continue to be at a high level, and of course it's not good for the US economy, but it's going to be good for in terms of maintaining the growth level. So that's why we say unrestrained. So how can you keep on injecting growth into the economy? We'll show you a chart later, but just to give you a sense of how dominant government is in the US right now. So if you look at, this is the percentage of jobs. That means every new job that comes out, how much is government related, how much is the private sector. So right now, it's almost 60% all come from the government, if you look at the latest data. So just to show you the fiscal dominance of the US government. So this is basically jobs, government roles, healthcare, social. So that's why the negative thing is that it's not a private sector, but the good thing is that this will keep the US sustained. So you can the macro backdrop is that the US economy can sustain because there's so much government spending. So of course, when the government throws a lot of money into the economy, there must be a consequence. So the consequence is that they have to issue a lot of debt. So this chart basically shows how much debt the government needs to fund, because they have to borrow money to pay for all this deficit, right? So what has happened is that they need to borrow at least 2 trillion a year. 2 trillion from strange. Of course, some of it is a federal government, Federal Reserve, but basically every year, 2 trillion, they got to go out and borrow from strangers. Not from us, we don't really buy, but from all the domestic funds and so forth. So you'll notice that this is a huge compared to pre-pandemic. Apologies for that. So pre-pandemic, you will notice apart from that huge jar there. So the point here is that there's going to be a lot of debt coming out for the US. So that causes us to worry that interest rates will remain elevated, because you need to borrow and borrow. Where are you going to find this 2 trillion? China is not buying much more treasury. So that is the worry we have. The real point, of course, is this issue, you can talk about it for years, but the real test is that if assuming the Federal Reserve really cut rates, but the 10-year bond yields continue to rise, then you have a worry. Then interest rates are not going to drop, because you know that the market cannot absorb the amount of supply. Of course, why we're talking so much about this, nobody really, this is a Singapore briefing, but because it's going to impact interest rates, it's going to impact REITs and so forth. So that's why what we're saying is this is something that to monitor and to be mindful of. If the day when they cut rates and interest rates still rise, at least the bond yields. Then the other theme, I think this one is quite notable, the interest rates initially. So how you read this chart is that the blue line was where the market expected interest rates to be. So by December, everybody thought there'd be six rate cuts. So that's why the REITs actually rallied end of last year, because people thought that the interest rate is going to slope down. But then when it came to March, you can see there's a big jump. So then again, just a month, 2 weeks later, interest rate expectations has risen up maybe. So what it means is that market now is pricing in only 2 cuts, and that's why the REITs are taking quite a huge hit, which I think Darren can explain later. The other thing to note is that what worries us is that is the inflation, because the Fed can only cut if inflation comes down. So this is the red line. What the Fed wants to do is for the red line to hit the green line. But obviously, if you look at the current trend, it's not going to hit. It's actually going to bounce back up. And if you look at the trend line now, we think the rates could actually go to 3.7 versus the own Fed's expectation of 2.6. So now there's a lot of risk that we may not even get a rate cut this year, because the inflation is now coming down. And also the other worry is that oil price, of course, we all know oil price is also climbing back up. And oil price not only affects the CPI, which includes oil, so obviously it's going to affect, but even the non-oil components like services, there's an indirect impact. You can even notice here the gasoline price in the US, when it climbs up, it will also drag up inflation, can be wages, can be services, transportation. So oil price is not only just on the headlines, but in the core measure, there's something to note. And of course, this was a last minute slide. No, we usually don't talk about oil. But anyway, this is basically what we like to use to gauge the demand supply for oil. So this is the amount of barrels, excluding the strategic petroleum reserve. Of course, a bit unfair to use that, but you'll notice that the amount of inventory in the US roughly quite balanced. But right now, market is probably pricing in $15, depending on what number you want, all pricing premium into oil price because of what's happened recently in the conflict. So in terms of our base case, it's more likely base guess because geopolitics, you cannot, it's hard to predict and hard to put any numbers. So what we are trying to say is that it's a symbolic attack. Of course, it's only 3 drones. I mean, if you're attacking Israel with 300, they're not going to send back 3 drones. They probably send you back with 3,000 drones. But this time they need to send you with 3 drones. So obviously it's very symbolic. And most important for us is the transmission mechanism. So although there's a war, but most important is how it transmits to the oil price. So far, most of the oil facilities are intact. Despite all the conflict, no of oil facilities have been attacked. Maybe there are some oil tankers that go through the Red Sea, but facilities intact. OPEC might not react because so long as the oil price is high, mid-80s, they actually want it higher. So a bit above 90, they want oil price, indirectly speaking, above 90. Probably only when you get a triple digit above 100, then maybe OPEC might actually say they want to remove their oil price cut. So we think there's a lot of upside now to oil because of the premium, and OPEC is not going to do anything. They're going to maintain the production cut. And of course, what will also calm the situation is, of course, the US elections. Nobody wants, I don't think anyone's going to get elected if the oil price is $100, $200. So US also wants to control. So that's why we think the situation is contained, our base guess. Always remember base guess. But of course, things are elevated. I think we all know, we all read the newspaper. This is the first time Iran actually did a direct attack. So the game has changed. There is a lot of tension. So, but not to downplay it, but just to say that the recent events, we think it's a bit calmer now. It won't be exaggerated, at least our, again, base guess. Okay, so but one area that we think would probably cut rates, and why we talk about Europe, there's so many countries, is mainly because we covered Cromwell. So that's why we think in Europe, they are likely to cut rates. They said they're not Fed dependent, but data. So if you look at the data, if you look at inflation in Europe, it's collapsing very sharply, even faster than the US. So that gives them room to cut. The blue line is their so-called interest rate. They call it the deposit rate. And the most important is the orange line. So if you take into inflation, or a bit more technical for everyone here, but it shows that this is the highest in around 30 plus years. So it means that the monetary policy in the Europe is exceptionally tight right now. So it gives them cover to cut. And of course, German industrial production is also very big. So we think the one that will cut is probably Europe. And this is important because we have a buy call on Cromwell. So these are one of the few countries that, one of the few risks that could benefit if Europe, we think is going to be the one that cuts us. Okay, then we'll go to Singapore. Again, probably sideways, but what we want to emphasize on is basically, the currency. 3 reasons, again, that we think the currency will be the strength. This is probably more for a Malaysian audience, since it doesn't really matter to us. We all have Singapore dollar. But if you're a foreign or ASEAN investor, this is important because Singapore is probably the only AAA rated sovereign in Asia. I just took this from Wikipedia. It's open, but among the whole Asian countries, we're the only one. Secondly, there's still a lot of liquidity flowing in. Since the pandemic, if you can see the little February 23, our reserves now was about, before the pandemic, was about 200 plus billion. If you add on the amount of reserves transferred to GIC, you add that back on, you're probably about hitting about 500 billion. That's why we said plus another US 253. We're not sure the latest figure now because we're a bit for MES annual report, but there's a lot of liquidity that flowed into the country since the pandemic. So much so that we have to actually put it aside because it's too much. And of course, the third The third reason why the Sing dollar will still be strong was that the current account. So current account is basically our trade with the rest of the world. So how much we sell to the rest of the world, how much we buy. Okay, maybe we are stingy, we don't buy enough. But anyway, what it means is that as a percentage of GDP, we are one of the highest. So it's also a reflection of the strength. That means there's always a lot of liquidity, foreign currency coming to the country. So that's why the Sing dollar is strong. This is good if you're a foreign investor, but if you're a REIT investor with assets in Australia and all that, it's not so good. But we thought we'd just change the dynamics rather than show you about Singapore exports and all that. That's one of the bedrock for the Singapore market and the currency. Okay, with that, I'm going to hand over to Zain for technical, then we'll move on to our sector.
Okay, thanks, Paul. Hi, everyone. I'm Zain. I'm the technical. So I'll go through the technicals. I'll be covering the outlook of the Singapore market and as well as our large so in terms of our outlook for the Singapore market-wise, it's similar to our title for our equity strategy. It's likely going to just be drifting sideways. Looking at the ES3 ETF, which actually tracks the index, currently we are just seeing continued consolidation in this orange box over here. So for the past quarter, it hasn't really moved, and we're expecting that to actually continue into the next quarter as well. So we are expecting a target of about 3.5 to about 3.3 for the second quarter. When you look at the longer term trend, when it dates back to 2022, this is still currently trading in this main uptrend over here. So that is still quite correlation before we could hit higher for the index. Then the next one, I'll be talking about large cap pick, which is Genting Singapore. So looking at Genting Singapore, the chart is quite interesting. I think we could be seeing a rebound underway from the troughs. So the first thing first is that looking at the chart, we had this breakout of a descending wedge over here after a wave of selling over here that took place. And then secondly, there was a false breakdown below the 88 cents level, and subsequently price recover afterwards. So that's actually a good signal that actually the last bit of sellers were actually got rid over here before the price actually did a recovery. And then when you look at the latest price action is that the 90.5 cents level, which was a prior resistance, turned into a support over here, and price actually went higher. So we can see a series of higher highs and higher lows taking place. And we think that the stock will continue its recovery towards the $1 to about $1.01 level, which there was a gap over here after the earnings. So that could bring a 10% upside for this counter. So might be something interesting to look at. And in terms of our mid-cap pick, it will be Olam Group Limited. For Olam, we expect a continuation of a bullish reversal. So looking at the chart, we can see that there's some recovery in terms of price, especially after February. So the first thing first is the breakout of this downtrend resistance line over here. And then afterwards, you can see that price did a back test and subsequently move higher. So you can see that there's a bullish reversal trend taking place. The secondly is currently trading in this uptrend channel highlighted in orange over here as well, with higher highs and higher lows. And then another bullish sign will be that recently the $1.12 level, which was a prior resistance over here, could be acting as a support over here as well. So that could bring the price to go higher towards 129 level, which was the next resistance level take place of 15% upside again. Yeah, so that's all for the technicals. I'll hand over time to Glenn for the banking sector trends. Thanks.
Hey, thanks, Zain. So I'm Glenn. I cover the banking and finance sector. We'll just start off first with the banking sector, the Singapore banking sector. Okay. Yep. So majority of it will be how the banks are going to maintain their high dividend yields. So they all have increased their dividends quite drastically. DBS being the highest. So I think the main point of my message will be how would they be doing and maintaining this in the coming years. So the first one will be maintaining their NIMs. So with an expected sort of drop in the interest rates, how are they going to maintain their high NIMs? We do expect in 2024 and 2025, there will be a similar 6 basis point drop. But even then, if you look at the past 12 years, you can see that these levels is still higher than what it has ever been, even since 2010. So how are they going to do it? I think there's two. Let me just briefly talk about how the banks like get the NIM. There are two main things that they have it in for the net interest margins, and that would be their asset yield and then their cost of funds. So asset yield, you have things like, when you take a loan, that's how much they earn the spread. So that's the first point. And, for now, it's sort of capped. So the banks are limited on the upside. Secondly, would be putting in their excess funds into asset yielding interest yielding assets. So that's how they're going to be turning over. And there's a possibility for them to further increase their asset yields. However, for the banks, why we do anticipate a dip in their net interest margins would be mainly from their cost of funds. So we can see that the fixed deposits that they have been taking on is rather high. So let's say in 2022 and 2023, when you saw the net interest margins going very high, it's mainly due to the asset yields actually outpacing the cost of funds. But currently, their cost of funds, it's like something like a deposit cost, fixed deposit cost, has been creeping up slowly, but asset yield has actually been sort of stagnating. So that's one of the things and one of the ways that the banks are trying to sort of curb. So that's one of the ways that they'll be trying to maintain their NIMs. I think we've seen that recently with UOB cutting their signature one account interest rate. So we'll see that more, I think, in the coming months. So, okay, another way, so I was talking about the UOB one account. I think that goes under their current account, savings accounts, or in short, CASA proportion. So we have seen this quite big decline since 2021, mainly due to the move from current account, savings accounts to the fixed deposits, because fixed deposits were giving really high interest rates without having to meet any sort of criteria or eligibility. So that's why there's this sort of a steep decline all the way until the last year, mid of last year. However, I think that's a positive for the banks is that we have seen it maintain at this 18+% level for their CASA ratio. And this is quite positive for the banks, means that they have managed to control their outflow of their CASA. And, I think moving forward, they will be trying maybe to increase it slightly or even just maintain it at this 18+%. Yeah, another point for the banks, for them to be able to maintain their earnings would be looking at loans. So with the expected rate cuts in the second half of the year, the banks are looking to pick up their loans growth. And we have seen that you look at the last half a year, the loans have actually picked back up to flat. So we're looking at flat. And I think we're expecting around a low to mid single digit loans growth for the full year. Most of this will come in the second half of the year when the interest rates are slightly lower. But we can see that the market is sort of, getting used to these high rates. So, it's now flat. I think for the last month, at least, we have seen that it's flat. And the main segments where this will be coming from, I think what we are looking at, Singapore is pretty stagnant. So I don't think we'll see much growth in Singapore. But outside of Singapore, let's say ASEAN, the banks have all done quite aggressive acquisitions. So you look at UOB, they've done all around ASEAN. Even Citibank, OCBC has also done this small acquisition in Indonesia. So I think we'll be looking at the rest of ASEAN to see further loans growth for the banks at least. And this is also how they will probably boost their net interest income and earnings. Yeah, and then one of the last, I think the most important, fee income growth driver would be fee income. So the banks have all, if you look at the last quarter, the fourth quarter, you can see, at the top, net interest margins have been stagnating. Net interest income is now at low single digit or even a negative for UOB. However, what is boosting and what is propping up their earnings would be their fee income. You see, it's all double-digit growth. This is mainly coming from their wealth management sector, even their cards also. So they have done the acquisitions. I think UOB's acquisitions have also been quite successful, even DBS with their Citi Taiwan. So all these acquisitions made them to expand their wealth management arm. And we have seen that their wealth management, assets under management, or the AUM, has been steadily increasing for the past few quarters. But yet, the wealth management fee income has actually not been growing much. Mainly this is due to the market, so it's not really doing as well. So their spread is not as high as they could be. And also with, let's say the interest rates are going down, we also see the customers or the consumers moving more to more riskier and higher interest earning assets in the wealth management side. So that's another way that they can further boost their fee income, which will ultimately lead to their bottom line in their earnings. Yeah, so I think we'll just cover these two banks first, the OCBC and UOB. I'll speak more about DBS later as our stock pick. So for OCBC, we do have a buy call, and our target price is $14.96. I think the main points for OCBC would be their CET1. So that's their Common Equity Tier 1. So that's the strongest capital that they have. Basically, for a bank CET1, optive range they're looking at will be around 12.5% to 13.5%. So currently they are at 15.9%, and that's really high. It's the highest amongst the three local banks. And what can they do to lower this, you might be asking. I think there are two ways. They can do an acquisition. So both DBS and UOB have done that. That's why they managed to lower their CET1. Or you can increase dividend payouts. So OCBC has done acquisition, but it's really small. I think around 200 million Sing dollars or so. So, but dividend payout, they have not really said much. So that's one of the, I guess, it's a positive as well, because during their calls and their conversations with them, they have said minimum is 50%. So that's all they said, the dividend payout ratio. But they did not say what was the highest they will go to. So, they do have to lower this, and with the new Basel rules coming in, I think it will further even increase their CET1 ratio. So I guess that could be one of the upsides for OCBC is that they could pay out even more dividends. And for them to reach their levels of, let's say, DBS, 7%, the CET1 would still cover around 15%. So it's actually not very far off to see a further increase in dividends for OCBC at least. Okay, so for UOB, we have a buy call also, and target price of $34.90. So UOB is actually our sort of least liked for the three banks, and mainly due to they're very strict on their dividend payout policy. They're saying only 50%, and even though we ask your CET1 ratio is quite high, you're going to lower it, say no, 50%. But on the flip side, if you look at UOB, the plus points would be that they're actually the sort of earnings we are looking at is the highest amongst the three banks, with a high single digit. And they are looking at it from, stable NIMs plus some loans recovery, and mainly is coming from P growth. And this would be into ASEAN, and they are banking quite heavily on their Citibank acquisitions. So they will not be increasing their payout ratio, but absolute dividends will increase because they are looking to grow their earnings by a high single digit. Yep, so that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thanks.
Thanks, Glenn. So I'm Darren. I cover the REITs and property sector. Yeah, so I'll begin the REIT sector by talking about the year-to-date performance as well as the 2023 performance. So as you can see here, the overseas commercial sector has been the worst performer over the past 2 years. So in 2023, it's down 30%, and year-to-date, it's down about 23.2%. So that's mainly because of the US office sector. As you all know, the US office sector is having some issues right now, especially with the debt refinancing, where a lot of the banks there, they are not to lend to US commercial properties. So as a result, we saw REITs like Prime US REIT, Keppel Pacific Oak US REIT, and Manulife US REIT having some issues there. And the worry right now is for Prime and Keppel Pacific, of course, they have a refinancing due this year. While Manulife, they've already gone through their recapitalization plan to divest some of the assets. So the other subsector that I want to highlight is industrial subsector, where 2023 it outperformed at 8.8%. That's really because of the asset performance. The Keppel DC REIT, they performed quite well in 2023. But this year is down 9.9%. Also, partly because of Keppel DC REIT, where one of the tenants in China, the Tong Data Center tenant, Blue Sea, they've defaulted on their loans, they've defaulted on their rental income. So they've on their rents rather, so they've been paying rents. They've defaulted and they've not paid rents for about 8.5 months already. So for the most recent quarter, they didn't pay 3 months, and the last year they didn't pay 5.5 months. So that impacted the DPU by about 6%. Yeah, and one more thing to highlight is just the hospitality subsector is the outperformer this year. As we saw the FY23 results, RevPAR numbers were still strong, and as a result, they were the only subsector that could their increased revenue could more than offset any increase in operating costs and interest expense. So we saw like a double-digit on average DPU growth for hospitality subsector, which was why it's up 5.4% year to date. And for the S-REITs index as a whole, like Paul mentioned earlier, is mainly affected by the interest rate expectations. So we started the year with 6 expectations of rate cuts, but now it's only 2 or maybe even lower. So that's why the year-to-date performance is down 8.8%. well, last year, towards the tail end of 2023, it managed to recover because of that six interest rate cut expectations. Yeah, next slide, please. Sorry, I have this. Yeah, so this is our first theme for the S-REITs dividend yield spread. So let me explain what this dividend yield spread is. It basically just means the forward dividend yield of the S-REITs index minus the yield of the 10-year Singapore government savings bond. Or if you can take a look, or more of a layman terms, is like how much dividend yield the S-REIT index is paying minus your fixed deposit rate. So I give you an example to understand this clearly. So let's say your fixed deposit rate is paying 1%, and the S-REIT index is giving you a dividend yield of 5%. So the dividend yield spread is 4%. So let's say in a situation where a fixed deposit rate rose to or rises to 3 to 4%, and your S-REIT's dividend yield is still 5%, would you be happy? You won't be happy because your yield spread is only 1 to 2%. So let's say if the base fixed deposit rate increases to 4%, you'll be expecting like maybe 7 to 8% of a dividend yield spread, or for 7 to 8% of forward dividend yield before you will be happy. So that is basically what this chart means. So right now, because of the high dividend yield, because now of the high yield on the 10-year Singapore government bond yield, or rather the high fixed deposit rates, we see that the 10-year dividend yield spread is trading at around -1 standard deviation. But our theme for this is that when interest rates come down, we expect the 10-year, or rather the yields on the risk-free fixed deposit rate to go down as well. And that will result in the dividend yield spread eventually increasing. So over the course of this year, we expect this dividend yield spread to increase back towards its 10-year historical average of about 3.6%. Right now, it's trading quite low. So our next theme is that we expect valuations to creep up. And right now, valuations, or rather the price to NAV, is trading at around COVID-19 lows. And that's mainly because a lot of the valuation impact of the property. So there's this disparity that we notice, like Singapore assets, rather REITs with Singapore assets, their price to NAV has remained relatively stable, or rather it didn't decline as much as a lot of the overseas REITs, especially with the US office commercial properties, where right now some of the overseas REITs are trading at 0.2 times price to NAV. So a lot of the overseas assets are trading at a lower price to NAV. So there's this disparity mainly because of the valuation worry. So right now, since it's trading at these low levels, and you see right now it's like almost 10-year lows. So because of that, we think that eventually we believe that valuations will start to increase, but this the impact might not be so fast because the interest rates are still high. So for this kicker to really start, right, we need to see interest rates come down before we expect the share prices to recover for REITs. But for REITs right now, this chart shows the forward dividend yield and the DPU year-on-year change. So if you look at the blue line, it just means that on an absolute basis, or rather on a DPU payout, the absolute number is right now you are getting more than the 10-year historical average. So that is attractive, the absolute number. But if you look at the columns, it just shows that the year-on-year growth, or rather year-on-year decline in DPU is right now it's around 8% for the most recent full year. That's mainly because of higher interest rates. So going forward, as interest rates still remain elevated, the expectations are that perhaps 1 or 0 rate cuts even this year. So we expect DPU to be muted. But we still think the hospitality subsector can generate a good DPU yield because of improving portfolio occupancy and RevPAR performance. Yeah, so let me just explain RevPAR in case you don't know. RevPAR, it just means average daily room rate times the occupancy rate. So for this sector, we still favor the hospitality subsector mainly because of the improvements in visitor arrivals as well as continued improvement in RevPAR. As you can see, the visitor arrivals right now is already hit since COVID levels, the visitor arrivals have already hit the high levels, but it has not yet reached pre-COVID levels. It's still down by about 5%, but it's the highest since the pandemic. And the kicker there is the return of Chinese travelers. So in the last month, we saw Chinese travelers come back 3 times year on year. And in the previous month in February, it's 10 times year on year. So that's mainly because of big major events like the Coldplay concert, Taylor Swift, Ed Sheeran and such. And the upcoming concerts as well, coupled with the big slew of MICE events. So visitor arrivals we expect it to recover to pre-pandemic levels by next year. And because of that, we have also saw average daily room rates at all-time highs in Singapore. So all this will help to benefit the hospitality subsector. And we expect RevPAR growth to continue, but might not be in the double-digit range as we saw in 2023, where 2023 growth was like very high because of the lower base in 2022. But 2023, the base was really very high. So we just expect perhaps a single-digit growth going forward for RevPAR. And for the hospitality subsector, here are some of our recommendations. If you are looking for more of a geographically diversified portfolio, we recommend CapitaLand Ascott Trust, mainly because RevPAR across the board in all countries continues to grow. And right now, the weakest ones are Vietnam and China, but we expect it to return to pre-COVID levels by this year or next year latest. And they still have 300 million of divestment gains that are sitting in the books that they can use to top up their dividend payments in the event of any unforeseen circumstances, or let's say some of the assets undergo AEI, they can just use that to top up the DPU. And they also have a good portfolio recycling track record where they have divested assets at about 4% exit cap rate, and they acquire assets at about 6%. And they're also divesting assets at about double-digit portfolio valuation above the most recent valuation. So they divested assets at about double digits more above valuation. Yeah. And our next stock is Five Hospitality Trust. So that's covered by Meow Meow. So FEHT is more of a Singapore play hospitality asset, hospitality REIT. So if you just want to be exposed to the Singapore side of things, like from the previous graph that I showed, that is in Singapore. So you can look into this. So for FEHT, the RevPAR, of course, continues to recover both ADR and occupancy, and they also have a divestment from Central Square where they can use to top up DPU. There's some capital gains there. And our next subsector that we favor is the retail subsector. So this is just mainly for two reasons. One is supported by limited supply. So as you can see, the 3-year average supply incoming is 0.38 million. So this is about 1/3 of the 10-year average. Other thing that supports this is the fact that we expect rental reversions to continue to recover, mainly because we expect tenant sales. The outlook for tenant sales is still good, and the tenants, when they are negotiating the leases with the landlords, they believe that, or rather that because the outlook is good, they are willing to pay higher rents. So because of that, rental reversions, we expect it to be mid to high single digits for both downtown and suburban malls. And the international visitor arrivals to Singapore increase. The increase in that will also help to improve the tenant sales going forward. So some of the stock picks that we have for the retail subsector. First of all, FCT. FCT is a suburban mall. So its occupancy is almost full already. And right now, occupancy cost, it just means how much rents they are paying divided by the tenant sales. So right now it's 15.5%, and that is on the lower end of the historical averages, and this is a healthy level. So we believe when they renegotiate the leases, they still can increase the rents. And the next is land lease REIT. So for land lease REIT, they have stable yield from suburban malls. So that is the GEMS, and upside from central malls, which is 313. And they also have a potential divestment of Sky Complex. So that land lease is covered by Meow Meow and Suntec as well. So if you have any questions, you can ask her later. And for Suntec, right now their rental reversions are quite resilient, and they have a low fixed rate loan. So this low fixed rate loan will benefit from any interest rate cuts. So if interest rate cuts, let's say later half of this year, they'll immediately benefit. And right now, Suntec is trading at 0.5 times price to NAV. So like I mentioned, Singapore assets, they have been trading at a higher price to NAV, but for Suntec, the NAV price to NAV is lower. So because of that, they favor that as well. And they have a 100 million divestment plan from the Suntec City asset that they might use to pay off some of the loans to lower their gearing. That's all for me. Hand over to Peggy. Thanks.
Morning, everyone. Thanks for coming. My name is Peggy. I cover three sectors here today: Congro, building materials, and air transport. Conglomerates. Okay, you see the two big names here, Keppel and Sembcorp. Maybe the first question you ask me is, are you sure, Peggy? Because Sembcorp is already up 25% since the last time I stood here 1 year ago. Right? Is it still a buy? But our positive. Why we are positive on these two stocks is really because of their exposure to the power sector in Singapore. If you think about, you want to buy AI, you want to buy robotics, automation, all these new trends in the markets right now, then you can think about even think about data centers. These are the technologies that would need power. So energy demand is going to be strong, and even for data centers, you need a lot of cooling. For the AI data centers, you need a lot of cooling systems. So that also demands a lot of power, additional power to cool them down. So therefore, power demand is likely to be sustained and is likely to grow. And our two conglomerates here really, for Keppel, 67% of their income comes from the traditional power. Sembcorp is about 64% of their income. So power provides the stable recurring income for these two companies, which is the reason for our buy call for the two of them. These two charts are just to show you how much of their power capacity they have contracted with the customers. Like for Keppel, only 10% of their capacity is exposed to signed on a less than 1 year contract, meaning to say that they have tied up all their customers, more than about 90% for long term. And this means that the demand will be sustained. Same thing for Sembcorp. The spot market, they're selling only 1% of their capacity on the spot market. That means most of the capacity has been contracted. So they just have to make sure they go into the power plant, turn on the lights, turn on the electricity, let it run, and then the revenue will come in. So compared to 1 year ago, this pie is probably about 1/3 is exposed to the spot market. So the two of them has already locked in this income stream. Therefore, that's the reason for our overweight rating for the conglomerate sector. Okay, so our recommendation for Keppel, our target price of 7.98 is some of the parts valuation. On top of the power income, which we think will continue to provide the base, the upside to Keppel comes from the strategy to do asset recycling. The reason for asset recycling is to raise their ROE. And as all of you savvy investors know that once the ROE improves, your price to book will also rise. So and that means that your share price will grow. Right? So Keppel has this strategy and they're working towards that. I'll show you a chart later when I talk about Keppel to see where this recycling will come from. And of course, some of these assets are recycled to be injected into their funds under management, and from there they will earn a fee income. So there's a double bite on the cherry. Okay. For Sembcorp, besides the gas power business, which is stable, they also have been building up very quickly on their new renewable energy projects. Even though renewable energy might give a lower ROE, right? But renewable energy has a higher pricing multiples accorded to them. So overall, it just will continue to raise the valuation for Sembcorp. So our target price is $6. For ST Engineering, I think the story is very obvious. Because of the geopolitical tension, the countries are just stockpiling more and more, just to make sure that they don't run out of ammunition when the drones fly near them. So across the world, you can see the budgets have grown for among the nations. And when the countries state a certain budget, they actually always overspend. So they always in the last cases they double what they spend, what they say they will spend. So therefore, not that it's good to rejoice when there's war, but this, ST Engineering is always a beneficiary when it comes to tensions. Thank you. Okay, for building materials, it's quite obvious. If you just look out from the window, you see all the cranes hanging all over Singapore, right? Especially where I live. Yeah. So if you travel to other countries, you don't see this scene. So only in Singapore you see the cranes hanging all around, and that's because ramping after that. So the last year, this is the construction awards number. Last year, for the whole of 2023, the awards was about 12% higher 2022. So the awards for last year will translate into work to be done this year. It's always 12 to 18 months lag. So therefore, we expect a lot more construction activities this year, which will benefit the construction company. But selectively, the local construction companies have a bit of headwinds, mainly due to the higher labor costs, labor issue, and then the quota has been revised this year, or levies are also revised. So there's a companies. But we think the sectors that will benefit from all these awards will be the building materials, the steel bars. And in Malaysia, the equally strong construction sector right now. So the cement producers in Malaysia are busy supplying to their own country. In fact, right now, for first time in a long time, you see Malaysian cement prices higher than Singapore cement prices. How do I read this is that means you don't see the Malaysian cement manufacturers want to send their cement down to Singapore and compete with Singapore guys. So therefore, we will have a better playing field here now in the Singapore market. So these are the two companies we cover and we prefer. BRC, there are many steel suppliers in Singapore, but why we like BRC is because we estimate they never want to say they never want to confirm this, but we estimate they have about 85 to 90% of the Singapore market for steel rebars. So you need rebars only in the middle stage of your construction work. So when you are digging the ground, doing the piling, you don't need. But at the end stage, you also don't need steel rebars. But in the middle stage, you need a lot of it. So this means quite a number of the projects out there are now going through this middle stage of the construction work for 2025. So the demand for steel rebars are likely to be very strong from this year onwards. And the lower freight rates help them because then the steel that is being import into Singapore, which will be cheaper for them, so the cost is lower. And I mentioned lower default risk is because most of the contractors right now, they have completed most of their low margin COVID jobs. So most of the construction sectors is now in a stronger position. So you don't see any news of another great earth coming along. Yeah. So for Pan United, this company has a 40% share of the Singapore market for ready-mix concrete. Right? And ready-mix concrete, yeah, it's actually a very homogeneous product, right? But what Pan United has been doing very well lately is they have developed these low carbon solutions. Right? It's not one product, it's many range of products. But layman terms, how you think about these low carbon solutions is they take the carbon dioxide, they pump into the concrete. The result is they gain some brownie points for being green product. And second thing is they actually this process actually strengthen the concrete. It actually make it stronger. And they have already sold these products to PSA, to CapitaLand, and CapitaLand has actually bring this product to Vietnam and other countries. So if you have these GLCs endorsing your products, we think there's a wider use of these products going forward. right, as the green focus becomes even more prominent. So therefore, for this, we think this product will give them the differentiation and make them differentiate from the other RMC suppliers in Singapore. Okay, air transport. Okay, I think I probably the best known air transport analyst to call herself, and not very well liked by the sector. Anyway, I shown this chart to illustrate the point is for the last 4 months, the load factor year on year has been falling. And how you think about load factors falling is that that means you have lesser demand compared to the capacity you have, right? So this is one illustrate for this room, right? So if we have if this is the plane, I fill every seats, right, my yield will improve. My yield will be very strong because I assume I collect $1 from each of you. So if I fill every seat, my yield is $1 times the number of seats. Right? But if I have some seats that are empty, right, I still have to fly the plane, right? So the cost is the same, but I don't collect say there are 3 seats here, I don't collect these $3. So what it means is my yield drop, and it dropped a lot faster when your load factors fall, right? Because your plane still have to fly, right? When the time is up, you're ready to go. Right? But so your cost is the same, but your yield will fall. So for that, it's coming through not just for SIA, it's also for the entire air transport sector. But what's not helping is that the war actually disrupt the traffic. So we hear about don't even say war, volcanoes, any little things like they will have to adjust they will have to make adjustments to their schedule and their plans. So all these are unnecessary costs that will be incurred by the airlines, right? And plus the Boeing's for some reason the door flew off of the window. All this while some of us might think, hey, that happens to the US airlines. Hey, we should be doing even better, right? But it's not true. The whole airline industry, while you compete with your competitors, you also need them. Because if there's connection problem, because the world is actually connected. So if you find that you want to travel to US, connecting to Tokyo, right? But that road is not going right. So you also cancel this road. So everyone is in the same boat. So they sink and swim together as well, the whole airline industry. So no one is a man of its own, an island of its own. So for that, the airline industry is facing some stress. But maybe show you the next. But my target price right now is only like 5% below the current share price. So the price has been falling. It's very near to the target price. So maybe I have to revise my call very soon. Yeah. But these target price are based on for SIA is a one-time price to book of the SIA's book value. My projection for March 2025. In this 591, have not taken into account a 40 cents possible upside when with the merger of SIA and Vistara. This 40 cents is just a book accounting entry. I don't know, for some reasons our accounting lecturer likes to do this non-cash thing, right? But so you might see the book value will be added on another 40 cents, which is $6.30. But in actual fact, the operationally the company we think is worth $5.91. So the same thing for sets. So if the airline don't fly, you don't need to cook so much. So there's a reduced cost at $2.31, and sets still have to refinance another 850 million Sing dollar loan, which is due in May. So until we see that being done, okay, we're not comfortable enough to make any change to our call. Thank you. So I have to pause. Thanks.
Thanks, Peggy. Yeah. Thanks, Peggy. I hope they still invite us for the analyst briefing, but anyway. hopefully. So I'll just run through a few more sectors, then we go through stock picks. So I cover the consumer and everything else. So for consumer, it's been tough. As you can see from the chart here, this is the ASEAN 6, including Vietnam. It has been tough, as the title suggests, because inflation spikes. So inflation is not the one-year event. After 3-4 years of high inflation, because commodity price went up and a lot of the emerging countries, their currency came down. As we always like to illustrate, in Vietnam, even beer had come down about, I think 15-18% volume down. So even a hot day, you still can't drink beer. That's how sad it is. So we're not advocating, we're just trying to illustrate the impact of inflation. But the other one I cover is Thai Bev. We'll discuss about it later. But the one that I cover is Sheng Siong. So it's a bit, we downgrade to accumulate mainly because it's going to be slow. There is more dining at home, or maybe more people go JB, but there is still a lot more dining. So there's a lot more grocery spending. But the problem is just the lack of growth. So just to give you a sense of the growth, same store sales, that means every day people go and buy from the current shop. It's probably like 2-3% growth at best. And then their stores are only growing 2%. So that's why the growth is very low, maybe 4-5%. In the past, they used to grow their stores more aggressive, could be like 6%, 7%. So that's why we're a bit cautious. Don't expect much growth. They still hold, I think you saw in the press, people complain about the 300 million. I mean, there's some merit to it, because these days, Singapore market, sometimes the company have to give the return because the market may not give you the return. So you need to give back. You might be a bit more generous because they actually hold, they still hold a lot more cash. So the start to accumulate is going to be slow. And if they're not giving very aggressive dividends, then where are we going to get the returns? So that's why we're a bit more cautious on Sheng Siong. The China factor, I think that you have to take a 5-year view because they are still growing it very conservatively, which is the right way. But any growth from China, you're talking about, 5 years away. We cover healthcare. Not going to put any more aging Singapore slides on healthcare, but the one thing that's happening to healthcare in Singapore is the competition from overseas. So I think for the first time, even Raffles mentioned that at best, foreign medical tourism is going to be flat. At best, that means coming down, another word for at best. So very hard to show data on foreign patient tourism in Singapore because there's no hard data. But you just look at IHH, their own Parkway Gleneagles, you will notice that's the volumes in Malaysia. So the volumes in Malaysia is coming up. Not to say there's a lot more people getting sick in Malaysia, but you just want to illustrate that there could be also a lot of foreign patients going because of the currency. And what has happened also when we spoke to Indonesian hospital is that when the pandemic happened, it was almost their moment in a way, lack of a better word, was because a lot of them, the local patients, then tried the local healthcare and they realized this is not that bad. So that's why a lot of foreign tourism is affected by this. So that's why, this is not to say that no people getting sick, but just trying to illustrate. But you can see Singapore volumes for Parkway, because they're the only ones who give quarterly numbers. So this makes us a bit more cautious on hospitals. That's why we have neutral foreign competition. Lower margin from TCF, this is not traditional. TCF means the temporary hospitals. So because of competition, I think they are the last bit, they have to slash their pricing, 50% or more. And then China startup losses. China is again, everything China has 5-year view. Because no visibility, I'll tell you 5-year view. Q&M Dental, we like it because there's margin recovery. I think they expanded very aggressively. Then now they have to actually fill the clinics. So after they expand, then actually not many people. So they have to just slow down and try to fill it up. And there's also a software angle to it because a lot of treatments are, of course, there's over treatment, which everybody is going to be very careful, but there's also under treatment. So a lot of cases where you don't give, apart from just filling everybody's teeth, you could actually do higher value added. So they're using this to try to guide the dentist that you should actually provide more. Of course, you're going to charge the dentist too. The other thing is Hyphens Pharma is another healthcare we cover. This one you have to take again, they are actually growing their proprietary brands, the Ocean Health and all the others. But the problem for any branded pharma or any branded company in Singapore is the scale. You don't have scale. So even their specialty pharma margins, that means their distributor has more margins than their own products, which, normally your own brand, you should have better margins, but because you don't have scale. So your overseas competitor scale is so huge, they can even give you more margins than your own product. That shows how big they are. So this one takes time. They need to build and good management. So they just taking time to build that kind of proprietary brand portfolio. Property, I think most of you probably are expert, but the problem for property now is just the volumes. So even after TDSR, which everyone got hurt quite bad because of the volumes, you can notice that even at the trough, you're looking at 6,000-7,000 volumes, and now we're hitting at the lows. So one, of course, we are the additional buyer's stamp duty. Even though there were new launches, we thought 2023 the volumes could pick up because of the cooling measures. Even though launches jumped from, I think, roughly 1,000 in 22 to 7,000, but the volume didn't pick up. So that's why we have overweight mainly because of bottom up rather than the whole sector. So we could see the incremental, but it's going to be very soft. Of course, CDL covered by Peteran, so it's still a discount, but we just other people and I manage and I get paid for it. So that's a better model which I think best. Because competition from 10 competitors now to 2.5, and the other one is leading, so we call it half. So, but it's not only competition. So even in Thailand, competition has shrunk from 3 to 2. But the problem is the economy needs to be strong, because in these emerging countries, it's semi-discretionary. Most of them are prepaid. So if their income is better, they'll spend a bit more. Not like ours is all fixed, right? So that's why if the economy recovers next year in the emerging market, then this could actually help push up the mobile prices, which we think is one of the drivers, at least for Singtel. Then some of the telco stocks, Netlink, 6% yield. It's very easy to forecast is a 2% growth for the next 50 years because that's the growth rate. Sometimes you're not sure what to write because it's just so stable. But the only impact to be mindful of is that they have a big loan that is due 2026. And because this loan, they borrow at 1%, which is an asset, not a loan now, right? You can borrow at 1%. So when that refi happens, it might impact the yield depending what interest rates are, but it could hit the dividend yield. But because this is a trust, I don't want to go too deep. They can actually borrow to cover it. But anyway, let's assume this is a 6% yield forever. Okay, that's as much as it. StarHub also has the share price did a bit better because we think they are also paying a very attractive yield and they committed to it. So it's almost a done deal. They're going to pay you this 6%. The thing that we're not sure, we are a bit more mixed here is that because they spend almost 300 million to do restructuring, in another way, that's to fix the IT system. But of course, it's not that. I hope they don't hear this. But it's also, the thing is, we're not sure of the restructuring benefits. Cost, we can understand, or you cut costs easy, but the revenue side, like how to get everyone to pay more for the mobile phone or pay TV, I really no idea how that's going to work. So we are still waiting for that. Then if that happens, the share price can move. They also have a hidden jewel in there, which is their cybersecurity. Like I highlighted, most of us don't put any value to it because the EBITDA is very meaningful. So But cybersecurity is a very treasured asset here. But just that is a kicker to valuation, which I think the market hasn't priced in until we see stronger numbers coming out. Then that could actually help the share price gap up. Of course, the other thing is consolidation. That one is another kind of a hidden catalyst for the share price. Okay, anyway, for semiconductors. Okay, so this is, we'll just talk about the near-term challenge. So these are all the results. We took it from our US and our analysts, US analyst that covers semicon. So not a lot of numbers, but let me just explain. The one on the left here is the recent results. So like how they did. In red is the recent like ASML and TSMC. So when you think of semiconductor, you got to think of it in buckets. So the one that is making all the money, I think we all know, is NVIDIA. If you look at the third line, sorry, it's a bit small. They are the ones mopping up all the profit. You can see the earnings jump 700, whatever, like 8 times. But the rest aren't doing that well. Anything related to AI chips, which is GPU, that means the chips that are in data centers, are doing well. Micron, because every one GPU you need like at least 6 to 8 kind of or chips accompanying it, memory chips, and the one that's doing, and the rest aren't doing that well. So the problem, so for Singapore context, your UMS, Franken, they depend on the equipment side here. You see the box in orange. So that's why we say near-term challenge, because their customer ain't doing that well. You will notice their guidance for March, or at least for ASML for June, is down. So that's why we are a bit more careful in the near term, because if our UML, Franken customers are not doing well, then we don't expect them to do that great. And the other thing is, who are these equipment customers? So very complicated. So it's UMS customer, which is the ultimate guy, which is TSMC. The number is not here, but TSMC's guidance for CapEx, because they buy the equipment, right, which UMS and everybody makes, is flat. So that's why the growth won't be that strong for this year, because when your customer is not buying more equipment, it's not that they're not buying. If you take a step back, 2019 TSMC's capex was about 15 billion, which is a lot. I mean, it's like almost the whole market cap of a bank. But right now, it's still double, but just that it has come down a lot from the peak, about 36 billion. So that's why just assume that near term is going to be challenging. But the longer term is still going to be good. As the title suggests, we also read about this book, Chip Wars. So who won the war is actually Malaysia, I mean, in a way, because a lot of the semiconductors are hollowing out in China. So a lot of investments are coming out. Lam, Applied Materials are all expanding in Penang and so forth. So that benefits all the listed SGX companies here. I think I need to push on a bit. So that's why longer term is going to be a positive. Okay. So the thing about buying semicons, just for everyone's benefit, is do you buy the UMS Franken, or do you buy the ETS, or even buy their customer? I'll leave it up for you to decide. But what the chart shows is that, okay, the one that did very well is AEM. They did so well that I have to put in a different scale, because they are like 10 times up. But if you look at the rest, a bit hard to see, but you'll notice that the index itself, the Philadelphia index in green, and also the Applied Material, that means the customer of all these guys, is actually sometimes the share price does more better than them. So the question you have to ask is, should you buy the US guys, or should you buy the EMS? As a Singapore broker, of course, you should buy the Singapore by far. But the chart doesn't say so, but just for everyone's kind of reflection on. Okay, I covered two. Okay, because we say you can just buy the ETF, but for venture we are a bit more neutral. I know the market's a bit more upbeat. We just still think that the environment, there's a pickup, but it's a pickup against negative growth. So we still think it's going to be challenging, and they are still paying you 5% yield. So those who want to wait, don't mind waiting. Then you are still going to get 5% cash, and they have a 1 billion cash hiding somewhere, but they're going to give you that yield regardless. Okay, I will run through with our usual model portfolio. So we added 2 stocks. This is our model portfolio. So we added 2 stocks, which is Cromwell. We took up Fraser Centrepoint since they went into the Straits Times Index. So I'm not sure what's the upside coming anymore. So it's like you didn't want the FA, you didn't want the FA Cup. So what's next? Nothing much, or World Cup, or whatever. So then the next, we added DBS because of the yield. Again, this is just for illustration, the returns. We'll run through all of this. I think some of these names we repeat, so we're going to go quite quickly for some of these names. This is just for reflection. Again, we don't include dividends, we don't include brokerage, but again, it's just for you to understand the performance. So we are under about 0.7%. Sorry, let me go back. What hurt us the most, if you see, is actually Thai BEV is down 6% and also CapitaLand investment. So luckily I'm not explaining CapitaLand investment, so I want Darren will do it. I have to explain Thai BEV. Okay, so for Comfort, again, this is my 872nd time talking about it. So we still like it because it's still under earning. You look at the red line, so this is the profit. It is still below the peak. The pre-pandemic share price was 230 something. We still think there's upside to this, and you can see the blue bar is the cash. So why we think another year of growth is because they increased the taxi commissions early this year. I think 5 to 7. Sorry, they increased the commissions. The platform commissions to 5 to 7%. They introduced, so Zik is becoming a real catalyst for them to grow the earnings. And then the UK is, because UK got hit so badly of the bus drivers strike, they have to pay extra. Then now they are repricing all that. So UK is doing well. Even China is doing well because they need more cars. And so almost every segment is doing well. So we still think that this year will be another growth year. But they're still far from the pre-pandemic. You can see from there how much earnings. So we still think that the growth will still be there. I'll quickly go since it's the 800th time. Okay, so Thai BEV has been a disappointment. And one of the reasons is because the whole Thai market is also down. So for first quarter, the worst performing Asian market is actually Thailand. Worse than China. That shows how bad it is. So in US dollar terms, the Thai market was down, the worst performer, about 8%. So the sentiment over Thailand is still very bad. So we're just waiting for the macro situation. So one of the catalysts we hope is the digital. As you can see, this the consumption pattern is still very weak. So we hope that this kicker can actually grow for Thai BEV. So ours is mainly because the valuations compared to history is low. I think they are trading at low teens, and also we think there's still going to be the growth from one of the initiatives that the Thai government is going to do is to give, I think roughly about $300 to each individual Thai to spend within 6 months. Just buy anything you want. I said alcohol, but somehow it gets there. Whereas of course it takes a long time, but for us, our $300. Probably June, we're going to get some. But anyway, so it took them a long time to debate about this each individual. So we think that can help kick the economy. And that's why we say it's all macro for it to return. And they're going to give like a 5% yield. So for Singtel, we still think, although they wanted to sell Optus, the news, but I'm not sure who wants to buy, but the ROE is less than 1. I'm not sure there's a queue there, we were saying. But nevertheless, we still like it because we think there are a few share price drivers for Singtel. Firstly, they're still looking to dispose of assets, about 4 billion. Then they'll return it to shareholders. Second thing is, of course, every year they still collect like 1.4 billion dividends from their associates, India, Thailand, Indonesia. This one we think is the one that can help smooth the earnings, is the cost cutting. They already committed to 600 over 3 years. Most of it will be in Australia. Since you only earn 1% ROE, I think, now I'm sure how does that work? The unknown is NVIDIA, so they're going to do GPU as a service, like something like what your YTL is also doing. It's hard to put a number. You can make it out as you want. Because let's say 100 megawatt, they're going to. So this is going to be a data center, only all NVIDIA chips. So you can make out a number. You can take $100, then maybe 80% of the power they can sell. Then you times maybe $2-3 per kilowatt. Then you want to put a margin 50-60. You're talking about a few hundred million kind of EBITDA here. They never guide us how much, so I can make it up, but since nobody knows, right? So, but this is, we think also is another hidden catalyst for the share price if they can come and show the market like what kind of earnings they can get. So that's why we still like Singtel, because we think there's a from a bottom up perspective, there's a few catalysts. Last one, I know we talked about this. The red line, the rate is actually the net cash. So you notice the cash and the market cap is actually quite close because they're trading at 80%. So, but we need the re-rating because once they don't do share buyback, the share price will just drop. So we still like it because we think it's really cheap and we think earnings is going to recover because of the new 4 customers that we mentioned before. But when the results come out for the March quarter, we think that will be because the first half they grew their earnings about 40%, but the market doesn't care. So, but anyway, the cash is very high and it's not like yesterday they got cash. So they have been having 1 billion cash Hong Kong dollar for quite some time. So that's why we still like it for the valuation perspective. Okay, I think I need to rush this. I'll move on to Glenn. Thanks.
Yeah, thanks, Paul. Yeah, so for our bank pick, it will be DBS. And I think it's pretty obvious with the title there. The dividend yield is actually the highest and it has reached this record high. So for DBS, like I think the main question being, how would they maintain this high dividend? So firstly, I alluded to it a bit earlier when I'm talking about the banks, their net interest margins. So they have said that, what they will do for the top line is to roll over their assets into higher yielding interest and lock it in. So that is how they will manage to sort of get higher interest on these assets that they have. So loan yields, I think, have capped already, as I mentioned. And the second part would be their funding. So, I think they're not really as aggressive as UOB by cutting their current account. But what they will be doing would be sort of not maybe refreshing their fixed deposit interest rates. So they might not be as aggressive to try to take on as much deposits, and giving very high interest rates, which we saw about 6 months ago. And they're willing to let go some of these deposits. And why is that? It's because, loans is not really growing as fast. So they have so much deposits, but they have nowhere to put it. So what they're doing is that they're saying, okay, we are going to let go some of this. So this will sort of balance out their net interest margins. I think we are only expecting a few basis point drop in this coming year, and at least for the next few quarters. So that will maintain their net interest incomes, and it's a bit of a sort of a switch between both the loans growth and net interest margins. So if interest rates do drop, net interest margins might dip, but at least loans growth will pick back up, as it's more attractive to pick up a loan instead. And I think the second point would be their fee income. So they have said, if you look at DBS's wealth management, assets under management, it has grown by 23% year on year for FY23, and that's quite high. But look at wealth management income, it actually hasn't risen much. So as I mentioned earlier, how are they going to increase this further? It's as all the fixed deposits and all the interest has sort of stagnated, right? We might see that the customers might be wanting to put into the wealth management and to get more interest. So that's how they will sort of expand their margins on this. And the second point for fee income would be their card income as well. And I think with the Citi Taiwan acquisition, they have seen it grown quite significantly. So there's the two ways they'll be growing their fee income. So I think fee income again would be the main driver for DBS's earnings. And I guess the main and the most important point everyone's talking about would be their dividends. So their dividend, why we like DBS is because they are the highest dividends. Not only that, secondly, they are the clearest at how much they're going to increase it by and how much they're going to give back to shareholders. So UOB is very strict at 50%, and then OCB, they're not very certain. But DBS has said, okay, during the investor day, we're going to give you 24 cents increment every year, and they're going to maintain it. They keep reiterating this every quarter during their results. And on top of that, they have given the 1-for-10 bonus share issue. So we're looking at around, if we put this all in at the current share price, I think the dividend yield is around 6.7%. And that is really high for a bank. Before that, I think before the announcement at their fourth quarter results, it was hovering above 7, but now it has dipped quite a little bit to 6.7. It's still the highest amongst the three local banks. Hence, we like it and we have a buy and a target price of $38.90. Yeah, that's all for the banks. I'll hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so our next stock in our Absolute 10 is Cromwell European REIT. So this REIT we just initiated, so that's why we have two sides on this. So we like this for a few reasons. So first of all, they have a very resilient portfolio. The occupancy is about 95%, and over the past half year, they managed to come in positive rental reversions of about 5%. So this is the 6th consecutive half of positive rental reversions. So that is a very good track record. And furthermore, they have also a good divestment plan. Over the past 2 years, they divested over 270 million at above valuations. And they have another 160 million that they are up for divestments. And these 160 million are mainly from their weaker assets, weaker office assets, which were Grade B and Grade C in Poland and Finland. And on top of these weak office assets and weak transactions market, they still can divest these assets likely at above valuations. So that's their track record. And their capital management-wise, they only have one loan that's expiring in 2025. They do not have any loans expiring in 2024. So this loan is actually a bond. It's a 500 million euro bond, and they've already repaid 50 million euros out of it. So these divestment gains, or rather divestments that are expected to be completed over the next couple of years, so they can use this to pay off some of these loans and to lower gearing and further lower interest costs. So those are two reasons. And because of the divestments, they have absence of income. So as a result of the absence of income, this is my forecast for DPU. So we expect the DPU to drop in FY23, to FY24, because some of the divested assets are some of the bigger assets and trophy assets previously. So right now, even though after accounting for the absence of income, we still project a 13.76 DPU for FY24, and that translates to a 10% yield. So despite that, despite all this, we still get 10% yield. We think it's a good deal. And the only thing for Cromwell is that you'll be affected by the FX, the euros, when you collect your dividends in euros, for instance. And we expect a good recovery in FY25 as some of the redeveloped assets come back to contributing into the top line. And another reason why we like Cromwell is because of its price to NAV. Right now it's trading at a steep discount to valuation, 40% discount. So this is mainly because of the share price correction over the past half a year. And yeah, we have a buy call on Cromwell with a solid dividend yield of 10%. And we also like it because in high periods of inflation, like over the past year, their rents, or rather their escalations, are tagged to CPI. So most of it is 100% of CPI. So as a result, we saw the rental escalations for last year were about 5%. And next for me is CLI. We like CLI mainly because of its recurring fee income stream. So they have set a new FUM target of 200 million. So as of 2023, they have 90 million inside their FUM and 10 billion that are waiting to be deployed. So as interest rates possibly decline, we expect deploying this capital, 10 billion, to be easier, as if high interest rate, it's quite hard to deploy all this capital. It's hard to find opportunities to deploy capital. And furthermore, this fee income recurring stream, they benefit a lot from the recovery in hospitality. So their hospitality lodging fee income also generated a lot of growth over the past few years. So these two are the main reasons basically why we like CLI, because of the recurring fee income stream, which is very stable, and when we expect them to hit their perhaps 200 million target. And the only weakness for CLI is the operations in China, where we saw rental reversions are being affected and that contributions are lower, but we expect this to recover perhaps in 2025 as the asset performance in China is still weak. A lot of these companies are prioritizing occupancy over rental reversions. So they'll rather their assets to be occupied rather than empty. So as a result, they're hit by rental reversions, but we think this will recover in 2025. So as a result, we still like CLI, mainly because of these reasons: recurring fee income stream, and that right now they are trading at about they're trading at dividend yield about 4%. Yeah, so that's for me.
Thank you. Thanks. Okay, maybe further elaboration on why we think Keppel is still a buy. Okay, the three things you can look out for Keppel besides the power story. First thing is they have about 4.3 billion worth of notes receivable in the balance sheet, which in the near term they want to liquidate, which means they can see potentially 4.3 billion cash coming back to them. This notes receivable is what they receive after they sell their rig, the legacy rig assets into a fund, right? So now that the oil and gas the O&M market is recovering very strongly, the day rates are stronger. So the rigs are now getting fully deployed. So we think there's a good market for this rig, and the potential of this 4.3 billion coming back in the near term is quite possible. Okay. The other second reason to be optimistic about Keppel is that this number 12.6 billion is the amount of assets that is in their balance sheet. The balance sheet total assets is about 68 billion. 12.6 is about maybe 18% of the total, which is targeted to be monetized. So what is inside this 12.6? It includes, of course, a lot of it is real estates. Right? In the past few years, you can see the asset monetization were mostly from real estates. But they also have $2 billion worth of data centers, which they would like to dispose and book again. Then on the infrastructure side, they have Keppel, the KMC, the desalination plant out in the marina, Keppel Marina, and some assets that they could like the undersea cable which they could dispose, or they could find a partner and sell part of their stakes in. So that's one. And of course, the M1 stake was potentially going to be sold after they migrate all the business up into the cloud and transform into a asset-light platform. They are ready to dispose of M1. So the company thinks they can get more than 1 B from M1 from selling M1 alone. So this is the immediate-term target. In the longer term, by 2030, the Keppel wants to be managing 200 billion worth of funds under management. Right now, after the recent announcement of the acquisition of Egmont Capital, they already hit a 77 billion target. So this 200 billion we think is possible for them to achieve. And with this amount of funds that they manage, they'll be able to generate fee income. So this fee income will become another recurring source of funds source of earnings for them. So therefore, the Keppel's share price catalysts are quite evident. Thank you. So the other stocks we have on the Absolute 10 is ST Engineering. This is a world defense budget data which every countries will make known every year. So in 22 to 23, there was a jump of about 4.7%. This is the budget, but the actual spending that happened in 2023 was 9% higher than 2022. So they actually spend more than what they said they will spend. And for the next few years, the annual growth the countries have projected across the world, not just Singapore, across the world, is 4.9% growth. And again, we think they are not going to stick to this number. They're going to be higher, probably another doubling. So maybe another 10% growth per year. So this is a very strong data even for Singapore, because ST Engineering don't just have their defense earnings from Singapore. They also sell worldwide, though they don't want to say too much about that. But we are actually a very strong player in this segment. And defense and securities accounts for 64% of their EBIT of ST Engineering, right? And this segment also gives them the highest EBIT margin of 13.3%. So if this segment keeps growing, you can just think about growing bottom line, growing margins for ST Engineering. So by hitting the 450 target, our 450 target, I don't think it's too difficult. Yeah. Thanks. So the China Aviation Oil, we also have it on the Absolute 10 portfolio. This is a play on the international air travel demand in China. Okay, we always hear all this negative about China China Airlines not allowed to fly to US petition, don't let China come in and so on. But in actual fact, the China international air traffic if you focus on this, not sure what color is this, the passenger, they are right now for the entire China international air travel is only 18% below the pre-COVID level, even though US market hasn't really come in at all. US is only about 20% of pre-COVID. So China has actually added a lot of flights to Middle East, to Europe, and those flights are very, very well taken up. The load factors are very strong. So for cargo, in fact, they actually hit 71% above the pre-COVID level. They're sending more cargos out through the air. So what this means is that when there's more volume, they need more jet fuel. And China Aviation Oil supplies the jet fuel for the international flights in the Chinese market. They are the dominant player in the five most busiest airports in China. And when volume grows, it will help the margin. Because if it is a smaller volume during COVID, they could only just do a back-to-back business, take the I take my orders and then I fulfill it. But when the volume grows, they actually go now directly from refinery to the end customer. So with this, they cut off all the back-to-back trades and the margins improve. So we think that the profit growth for our projections is derived from both volume as well as margin expansion. Okay. We initiated Thomson Medical in this quarter. I just talk a bit about why we like them. Okay. As we all know, Thomson is 90% owned by Mr. Peter Lim, right? When I issue my report, the feedbacks I got from mostly the Insti investors is that, hey, Peggy, are you okay or not? This is very high gearing, you know. Their debt is up to the eyeballs already. Yeah. Yeah. But the thing is about, if you look carefully at the data, right? Like Paul has mentioned earlier, Singapore healthcare sector is actually on the decline. Right? After we had the COVID, during the COVID years, the Singapore government pumped in a lot of money to give us vaccination and so on. The healthcare sector had a good run, but it had fallen because of the foreign patients are not coming in. So the recent acquisition of the Vietnam hospital is actually a move in the right direction, because the bar here, the green bar here, is what we think the Vietnam will contribute. And then with the Vietnam's acquisition, it will bring them higher than even 22 and 23 in terms of revenue. And EBITDA is the same picture. So this Vietnam acquisition is very strategic. And because in Singapore, we actually see a lot of Vietnam patients coming in, right? But they're not coming in anymore. In the past, when they come in, they will bring along their own translator also. So their whole entourage. Right? But now they find that in their own country, during COVID, right, they couldn't travel. They find that actually in their own country, they could get similar standard of care and treatment. And the scope is the same. So, and it's cheaper also. You don't need to bring a translator with you. So most of them wants to stay in their own country. And therefore, Thomson's move will anchor them to capture that Vietnamese market, as well as patients from Thailand, Laos. Then the other hidden value of Thomson is that they had in their balance sheet, they had $100 million worth of freehold land in Iskandar. Right? So this land has already been sitting in the balance sheet, and therefore incurring the cost. So the cost, together the purchase of a Vietnam hospital at the end of last year, the net debt has risen to 835 million. But as they develop the land, they already incurred the land cost, right? As they develop, which we think is going to accelerate, the plans is going to accelerate, the cash flow that comes in will be able to reduce this net debt. And we think the Iskandar land, when it develops, will produce a 1.1 billion worth of profits. This is the potential profit from the Iskandar land. So that's why that's how I arrive at my target price of 0.066 per share. My Iskandar lands, the prices, the current value that the ASP that's selling in the property in Iskandar is already higher than my value. So my number looks a little small compared to the what you probably see out there. Yeah. So this is a very conservative numbers. So this Thomson at the current share price gives you this upside in terms of 363 million worth of market cap gain. Thanks. Pass on to Mel for 175. Thank you.
Thank you, Peggy. Thank you. Hi, I'm Mel, rate analyst, but I also cover streaming sector now. We initiated on 175 early last month. It's a streaming platform listed on SGX end of last year after taking over Vertex Technology, the SPAC. Revenue generated by 175 are mainly through selling of virtual coins for both live streaming and very live streaming business. Here's a photo on the on the left, is the revenue contribution by segment. Majority of the income is contributed by the normal live streaming business. However, we expect the catalyst actually to come from VLive streaming business. Different from the normal live streaming, VLive is you use the customized animated face. Something like this. So it's called skin. It used to cost $1,000 to $2,000 per skin and takes weeks to generate. But now with the advanced technology, it's almost instant and free. So we expect increasing numbers of VLive streamers to drive the revenue growth. So we like the stock mainly because we believe they can further monetize on their core user base and streamlining on some operating expense and to improve profitability. After revenue declining for 3 consecutive years, we expect them to stabilize from this year onwards. This is because they intended to improve the user retention rate by providing more user-friendly functions and also providing some trainings for their streamers, like how to greeting their users and how to provide more interesting and engaging content. So we expect revenue and we expect MAU to increase by 10% organically this year. And also, 17Live is shifting its focus towards higher margin revenue, like live commerce. They observe increasing demand for cross-border live commerce. So we expect this segment to grow by 40% in terms of revenue this year. And like mentioned, the company is also working on cutting down its costs. There's 15 million cost reduction from R&D expense without hurting the user's experience. And they are also constantly reviewing and optimizing on their contract for streamers. Essentially, it's just to cut down the revenue sharing for streamers to improve their profit. And they also observe a behavior of cross-border virtual coins arbitrage. So Japanese yen depreciated a lot in FY23. So some customers actually choose to purchase the virtual coins in Japan and spend it in Taiwan. So they observed the behavior and implemented some policies to restrict this. And together with the contract optimization, we are looking at around 10% margin improvement for the margins in Taiwan. And lastly, we also expect some catalysts come from inorganic growth. Since they are currently holding 100 million cash on hand, they are eyeing acquisition of some new streamers with existing customer base. So approximately 1 new streamer is able to bring on board 20 MAU. So we expect the acquisition to be revenue and MAU accretive. And in summary, FY24 onwards, revenue could be mainly driven by new content, live commerce, cost reduction, and inorganic growth. So we initiated on 17Live with a buy recommendation and target price of $2.3. That's all for me. I'll hand over back to Paul for conclusion.
So conclusion is we can go for lunch, but let me just roughly wrap it up. So global economy, we're not expecting really much strength, but it's going to be backstop. Any downside is going to be protected by US government monetary fiscal. The Fed is shackled. The Fed don't expect it to be able to cut rates. And the risk for the whole market is somehow if treasuries cross 5%, we just worried the market's going to, there's going to be another major risk-off move. I don't talk about the current conflict we have now. And then we're over these sectors. I think we can move on to Q&A. Thanks everyone for listening to us.
So actually we'll now move to the Q&A segment. So what we will start off is we will do the physical questions first before we take some questions from the online as well. So you first. Okay, so any questions that the floor has for the Paul and his team? Right, maybe we take 3 questions to 4 questions before I move to the online questions. Anyone that have a question can raise a hand. I can then move to you to,
Can you just comment on Asian Pay TV, which you all used to cover?
So for Asian Pay TV, It is mainly the debt. We liked it because at the time interest rates were low and they were paying a very strong dividends. But right now, it's just that they have to face this higher cost debt, and actually haven't really been watching the recent results briefing. Peggy, you got anything on the operationally? Yeah. It's more the interest rate issue right now. Yeah, I haven't really been.
Yeah, so a few things here is two things here is they had to write down the value of the assets, right? They did a reassessment of the value of the assets. That they did it recently, which we thought they should have done it earlier. Anyway, so there was write down a value of the asset, so the book value has fallen. And second thing is for something that none of us has ever imagined, Taiwan actually raised the interest rates. So TIBOR has gone up. For APTT, they always enjoy lower interest rate because of the TIBOR segment, and they have in the last 4 quarters they've tried to refinance their Singapore loans into Taiwan dollar so that to reduce the interest rate. But this trend looks like it's going to reverse. So in the next 2 quarters, we probably see them guiding us a higher interest rates environment for them. So therefore, I think the market is trying to price this into the valuation of the company. So yeah, so the last bright spot for them is also a diminution for that reason. I hope I've answered the question.
Yeah, hi. Okay, I have a question on REITs also. It's a general question on the sector. Okay, I read a report from DBS 2 weeks ago that the market may be slightly underpricing the risk of refinancing from PERPs and hybrids. It's they launch a lot of such things maybe when rates were low, but now we could be facing higher for longer. So this is a real risk. So if they reprice, maybe their reputation may suffer. If they don't reprice, then the gearing will go up. So it's a general question on the sector. How do you think the REITs will have to face this in the months to come?
Yeah, that's actually a very good question. So actually, in our view, we think most of the PERPs that are outstanding now in the market, we think the REITs might call back because it just makes it makes sense for them because first of all, their gearing it might increase, but like using the most upcoming one is Paragon. Even though if they recall the PERPs, their gearing will still be below 45%. If I'm not wrong, I mean, it might be 42. I can't remember the number. Yeah, 45 is the MAS limit, right? But even if they recall back, their gearing might be 42. I can't remind you to calculate again, but it's definitely still below the limit. Yeah. So sector-wise, also a lot of REITs right now, other than like the overseas US REITs, for instance, the gearing is still in healthy levels. So a lot of the REITs have the capacity to actually pay off or call back the PERPs to save off on interest costs as well. So we think that will be the case for most of the PERPs that are going to be outstanding this year. So like gearing might increase, but overall interest costs will come down because of that. Yeah, cost right now, if you refinance the PERPs, right, you really pay a huge spread, and like I believe like perhaps definitely will be up by at least 200 over basis points as compared to the last PERPs rate. Yeah. Thanks.
Hi, you spoke about REITs. I wanted to know your thoughts on ARA US Hospitality REIT.
Actually for that, I'm not so familiar with that particular stock, so I need to check more. But basically, hospitality across the board, we think we are still positive on that. Yeah, because of the flight recovery, like the flight capacity, the number of flights rather is still increasing, and as that increase, overall, the visitor arrivals and travel will pick up, and that will benefit hospitality. But for ARA US Hospitality specifically, yeah, I'm not too familiar with the asset, so yeah, I need to get back to you on that.
Okay, so we'll move to the last question for the physical before I move to the online questions.
Just a quick question on ComfortDelGro. okay. ComfortDelGro. Okay. This is what I hear from not from a professional analyst, but hear from coffee shop talk lah. Like saying that
Better maybe.
yeah, the coffee shop talk saying that the talk is that there's a risk that one day the government might allow street hailing for Grab and PHVs. If that's the case, right, then everyone will be going to drive for Grab and the PHV. So that will be bye-bye for ComfortDelGro. So the market is very smart. No, I've been looking at the price of ComfortDelGro. Why is it stuck at 140? The market knows that there's a risk out there. The market is very smart. So I don't know whether you want to comment on it. Is there such a risk?
The street hail, there's a proposal to restructure. There's one more proposal coming up to restructure. Actually, street hail for me is actually, if you look at the URA does provide, the LTA does provide stats, street hailing versus ride hailing. So of course, street hailing is really collapsing. So even if they're opening up, it may not really affect that, because if they really give something back to the ride hailing, they normally will take back something. The government will equalize it. It won't just punish the whole. Historically, I mean, if things, but street hail is actually it's actually coming down. The volumes are trending down. I'm not so worried, and you have to assume. Of course, that's the assumption. The LTA is not going to. Or if I do this, I just want to kill the whole taxi industry. And driver shortage is now pretty intense. So for me, there would normally be a balance to it. Just to answer, for me, what is holding it back is people just want to see performance. Since they're disappointed for 2 years to share the results. And on a PE basis, this stock isn't very cheap. It's like high teens. So people want to say, show me first, then I'll buy. I'll do. Yeah. Thanks for that.
Okay, so I think Darren will be for your online questions. I think there's quite a lot of questions on the property and REIT sector, which I think even those in the physical attendance will be interested in. So one of them actually in general, I think I just group them up, right, is that for the next 6 months, right, looking at REITs per se, you're looking at which particular REIT do you think is better to hold, maybe by subsector or by specific, as well as property developers themselves like CDL and CapitaLand Investment. Do you think the outlook for property developers versus managers versus REITs, which is the way to go?
I think I'll just go brief by the question. So the first one, if let's say interest rates remain at current rate for longer, do you think REITs are going to remain low or worse, or prices or go down? So I won't talk on the perspective of share price, because that one no one can predict, but talk about fundamental performance. So basically, if the REITs are expected to, if interest rates are expected to remain higher and maybe 0 rate cuts this year, of course the REITs will be affected by higher interest rates expenses, and that will also affect inorganic growth, because with higher interest rates, it's very hard to get a positive carry. Positive carry meaning the amount of income you collect minus the amount of interest you pay. So a lot of markets, right, this is really a negative number. So that means you're paying more interest as compared to the amount of income you can take. So all this will definitely affect the REITs and the sentiment going forward. And even further maybe if that's the case, if interest rates will remain high, perhaps even into 2025, you might see DPU decline year on year and not grow. But currently, our expectations are that DPU will start to recover in 2025. So year-on-year growth in 2025 is expected to be positive. So which are the REITs to hold? One of it we'll say is Cromwell, because it's in our absolute 10. And one of the reasons is because we expect ECB rates to be cut earlier than perhaps the Fed funds rate as well. So that really benefit Cromwell specifically, because they'll benefit from the immediate impact of the lower interest rates. So that is one of it. Let's run through the next one. My view on Mapletree Lock. So Mapletree Lock, actually the REIT's performance in the past 2 weeks, it just all crashed because mainly of the interest rate expectations of lower number of rate cuts, or perhaps 0 rate cuts. But Mapletree Lock, I also noticed it fell the most. So I don't see any news. But the big thing that's affecting Mapletree Lock is the performance in China, because a lot of the e-commerce players, they expanded way too much in COVID period. So now there's a lot of consolidation among these players. So as a result, the demand for these logistic assets that were mainly for e-commerce use back then, there's basically very little demand for that now. And because of that, we've seen negative rental reversions for these China assets, and a lot of these landlords are having trouble trying to even occupy these assets. So if they want to have these assets occupied, or rather these logistics properties occupied, basically the rents that they'll be getting will be much lesser. So yeah, they're hit by that. So that is the headwind for Mapletree Lock. As well as a lot of other REITs and property owners who own these logistics assets in China. Yeah, the next one is, do you see further downside in the next 6 months, and what entry prices are safer for property stocks? So property stocks, mainly they are still hit by the higher ABSD. Paul mentioned a bit about it earlier. So the volume of transactions also are basically not there. So because of it, the inventory, a lot of these, they might not be able to sell, and launches, they also might hold back. Like for example, CDL, they held back their Newport residences. Was supposed to be launched last year, but just few days before they were supposed to launch, the ABSD 60% news was announced for overseas, rather for foreigners. So that really hit them. So do you expect further downside? Basically, in my view, this will really depend on interest rates, when it will be cut. So if interest rates are cut earlier, the demand might come back earlier as well. But if interest rates remain high, the mortgage rates remain high, it's quite hard to see recovering that quickly. Yeah, but for entry price, maybe Zing can do today, but maybe not today. Yeah, thanks.
Let me let's top up a bit. For CDL, it's going to be challenging because nobody's buying, no foreigners buying property. I mean, like 60%. So even if you assume the property price 6-7% a year, you probably take 8 years before you break even. No foreign investor with the right mind buy any with the ABSD at that. So it's going to be challenging for high end. And I think 30% of all the new launches are in core central region. So that's going to be a problem. For Mapletree Lock, I was checking my phone for the notes. I'm not going to do e-shopping just now, but it's mainly for Mapletree Lock. The problem is that 40% of the assets in China and Hong Kong. So that's already a problem. Then for Singapore, because this is a 20-year-old REIT, right? So most of the assets are 20-year-old, and then you not only have to rejuvenate. You know, because most of these are leases, right? Then you might have this sudden downgrade in your valuations. So that's why they have a lot more. Not just an interest rate, they got more other problems to think about for Mapletree. I'll just address the Seatrium. So share price consolidation might affect volumes, but in theory, you cut the cake 8 times or cut the cake 4 times, it's still the same. I mean, I obviously ate too much cake, but it doesn't really affect share consolidation or on paper, but it will affect the volumes because a lot of people like to play that 1 cent, half cent arbitrage thing. So the volumes will definitely thin by default, but the value of the trade might also be affected. Okay, I will answer one more on the last two, I guess, for Thomson Medical, Peggy, and also Glenn.
I spoke about the question is, you mentioned healthcare in SG under competition overseas. Can you share about Thomson Medical too and your view forward? Yeah, so Thomson's move into Vietnam is actually one strategy to overcome this competition that Singapore hospitals, Singapore healthcare providers are facing from the overseas competition. So therefore, having a base in Vietnam is very strategic for Thomson for this purpose. The other thing is Vietnam has a very open market where they allow the Singapore doctors to go there to practice, and you don't need to be specifically registered with the Vietnam authorities. So they are able to Singapore doctors can over there can be practicing in the Vietnam hospitals, in their Vietnam hospitals. So besides their own doctors, some of the Singapore doctors from other healthcare providers might also be attracted to join Thomson at their Vietnam facilities. So it's strategically, I think it's a very exciting move for them. SATS have both cargo and passenger in flight. If cargo demand increases due to sea transportation, wouldn't SATS prices? Yes, SATS bought WFS in April 2023. Is correct. So now US and Europe cargo accounts for about half of the revenue. But if you look at the latest quarterly numbers, the WFS only contribute, if I don't remember wrongly, only 3 million to operating profit. It's a single digit. So they spend like 2 over billion to buy WFS, and if every quarter they only contribute 3 billion, it's a very small number. So we think it takes a long time for WFS to give them meaningful contribution. Then at the same time, they still face with the WFS debt that they need to refinance. Yeah, so most of these debts are about 6%. They hope to refinance it to about 4 or 4.5%. But still, it's a debt in the books. So I think the gearing level, if the profits doesn't grow as fast, the gearing could be net gearing will rise faster than profit. Yeah, thank you.
Okay, thanks, Maggie. Yeah, I think I will just take this last question here due to time. It's about DBS. So after the bonus issue, how will it affect DBS share price? Someone also asked, what is the target price I have? Is it pre or post bonus share issue? So the target price is pre-bonus share issue 30. Yeah. And for this one, after the bonus issue, what will happen? I think to just put it very simply, is let's say the market cap now is like $100. You have 9 shares. When they give you 1 more share, it becomes 10. So technically, if everything else is equal, it will lower by 10%. So, but if you're holding the shares currently, actually it won't change anything. Right? The only difference is maybe if you are looking to enter later, what will happen to your dividend yield? So the dividend yield I've calculated earlier, around 6.7%. I'm assuming including the bonus share issue as well as the dividends which they have said that they will increase. Yeah. So 6.7, that is the dividend yield. Yeah. Hope that is clear enough. Hand it back to you.
Okay, so we'd like to thank Paul and the team for the Q&A. So the
we have this daily level certificate that can make things a little bit more exciting.
Hello, everyone. Thank you so much for joining our session. We actually have come to end to the session today, and would like to thank for all of you for joining. So for those who have would like to visit the session just now, we actually will be uploading the recording on the Phillip Capital YouTube channel. So you can actually view the recording of the webinar on your own time. Also, there will be any other interesting webinar going on almost every single day. So you can also view our full list of free webinar on our website. So if you do have any questions or any feedback, you can just scan the QR code, and then you can receive a slides from us. And at the same time, if you do not have an account with us, you can also scan the QR code to open an account with us. Meanwhile, so if you are interested, you can also join our community group. Be able to get a full access for full research report and discussion on the technical analysis. So I'm gonna wait for a while. for the participants to have the chance to scan the QR code. See if there's any question. Right. And thank you very much. Once again, thank you very much for all joining us. We really hope that I can see you next quarter. And thank you very much and have a good day. Bye.